finishing up almost 2% this week. It's the longest winning streak since July 28th. Could the market keep climbing next week when the Fed is expected to cut rates, or will this be a sell the news event? Well, let's bring in Payne Capital Management's senior wealth advisor and CNBC contributor Courtney Garcia and 314 Research co-founder Warren Pies. It's great to have you both here. Warren, I'm going to kick off with you with that question. Is next week a sell the news event if the market's already expecting a 25 basis point cut here?
Look, we're bullish on the market, 6,800 price target. It's tough to fade the market with this much strength, but if I had to guess, I would say we have a lot of positives priced in next week, and there's more room for the Fed to disappoint from my perspective. And just one thing I would look at, everybody knows we're going to get a 25 basis point cut next week. That's basically baked in. I think what we're going to look at is the SEP. So it's the summary of economic projections, and where the committee sees is guiding rates for the end of 2026. Right now, there's about a 70 basis point or 3 full cuts difference between the rates market, the SOFR market, at that point in time, and the current SEP. I think you need to see that number, those convergence. That's what the market's looking for. And if we don't get that, you could see some disappointment. Maybe rates spike up a little bit and equities sell off. And so I think there's some room for disappointment next week. Yes.
Okay. Courtney, I want to get your thoughts on this, and also the fact that in trading today, despite the fact that we had a mixed day and maybe on the top line, not major moves for the major averages. I mean, breadth was negative. Index performance really held up here, especially the S&P by big tech. Is that where you continue to park your capital, or do you look elsewhere, given a more broadening market in recent weeks overall?
Yeah, you definitely want to look to broaden out here. We absolutely want to own tech. I don't think that trade is over. I mean, if anything, I think you could start to see that even increase as rates come down. You start to see people rethink having all their money in money markets and putting it into the markets. As much as we're saying you want to broaden out, and I do think that's what you should be doing, you get a lot of investors who get this FOMO and they're saying, oh, I just want to be in this tech trade that's doing really well. And that really could lead that higher as interest rates continue to come down, if in fact that happens, which is widely expected next week. But yes, I think with those extra dollars, you want to think of things like small caps, which have more floating rate and short-term debt, and they're really set to benefit from rates coming down. Plus things like less regulation, more M&A. I mean, that's a space that really had been talked about, hasn't had the run people expect it to. And there's a lot of other great areas like energy, international. I mean, plenty of places to add your money. So I don't think tech's over, but I don't think you want to overlook these other areas of the market either.
Warren, what do you think looking across asset classes? I see 6,800 target for you for the S&P through year end.
That's right. We're still bullish on the market. We had that target coming into the year. We didn't ever dial it down. We kind of expected H1 volatility, and so we're still there. I think if you're going to get a pullback, I mean, we're in that season. You know, the second half of September is the weakest point of the market. I think it makes sense if you're going to be in the equity market here to offset that with a big bond position duration. And I know that's kind of not a popular thing right now. Everybody's looking at debt and deficits, but I think the defining characteristic of the macro right now, which is what we look at, is ultimately a weakening labor market, and everybody wants to write it off as immigration and a supply factor. But I think that the signs of true weakening in the labor market are starting to build up. So what that means is the risk to the equity market is ultimately on the growth side, and that means you need to have a bond position, which is a kind of an out of consensus thing for a lot of investors here who've been worried more about inflation for a while.
Okay. Courtney, I want to get your thoughts on small caps.
Yeah, I mean, I think this is a really good area that you want to look at right now, mainly because if interest rates come down, this is one of the categories that is set to benefit from that. I think this is really something that you want to look at here, because if the economy continues to stay on good footing, and I do think it is, there are questions about the labor market, which Warren brings up. There's a lot of other data points, whether you're looking at GDP growth, you're looking at companies' earnings, you're looking at how the consumer's holding up. I think we're going to continue to be in a strong economy. And if you're in a strong economy with rates coming down, I think that's one of the places that's going to keep you really well positioned. So I'm not overweighting it, but I find that a lot of people are underweight that area. And even a lot of our clients, because large cap's doing so well, are a little underexposed there. So that's absolutely one of the areas that we're looking at right now.
And Warren, just to dig a little deeper into your thoughts about the bond market right now. I mean, you say you expect the 10-year to break below 4%. What drives that, especially since it would be considered a more contrarian view when there is so much focus on debt and deficits right now?
Yeah, I mean, so I think there's a bit of a misunderstanding in the bond market. Everybody goes back to last year when the Fed started cutting rates, and they're like, well, the bonds sold off, yield spiked. That was, and many people said, hey, this was a Fed policy mistake. But you have to recognize what I call initial conditions coming into the cuts last year. So last year, yield curve was really inverted, more inverted than we've ever seen at the start of a cut cycle. And so that told me that the bond market was seized up and really expecting a recession going forward. And that's not the case right now. As Rick pointed out, we have a positively sloping yield curve now, twos, 50 basis points below tens. And so this setup tells me as the Fed starts its rate cutting cycle, we should expect to see rates across the curve start to come down. That's what happens normally. Didn't happen last year. Recency bias has a lot of people tripped up. And so I think the curve steepens modestly. But ultimately yields across the curve come down. And you're going to see that all important 10-year break below 4%. There are going to be a lot of surprised people when that happens.
Okay.